Good morning and welcome to our December Money Matters Mastermind. We are going to touch on some of the numbers from the month of November and where we're at year to date in a couple of areas. And then I am not going to bore you too long, and I'll be passing it over to Bobby Bodner of Breadify to talk a little bit about assets, liabilities, net worth, and then really prep you guys for some year-end items you can do to prepare for filing your taxes for 2022. So first, I would like to just say, share congratulations to everyone on the call. Our market center is officially the #1 most profitable Keller Williams market center in the world. So
It's a mouthful.
In the entire Keller ecosystem, we've been in the top 10 the last couple years, hovering at in the top 5 throughout the year, and as of the end of November, and it looks like hopefully we will be ending this year as the most profitable. So that is a testament to all of our agents and their successful businesses. So thank you to everyone who chooses to work here. We are happy to be in business with you. All right, so a couple things I want to touch on as opportunities as we continue to roll into ways that the market are changing, and items with our businesses that we might not be as familiar with, given the last 2 to 2.5 years of business almost falling from trees, I've heard agents say before. So listings, as always, is going to be an opportunity for us. It's a way that we can control our own businesses by having inventory. So stay on the lookout for the programming we have in the coming months, especially with Ignite in January, which is going to focus a lot on that and how that is going to drive your businesses for the next year. A couple other things, our average sales price. I talk about this almost every month also. We have continued to increase that over the course of this year. So we are now averaging the year at $247, and that's up 10% even from last year. So we're seeing closed units level off and kind of begin to resemble pre-pandemic years. Same with, listings taken or closed volume. But one thing that isn't going to drastically change is sales price. That doesn't just all of a sudden revert back overnight. So those are stats to use in your presentations when you're working with sellers and discussing your own value proposition to them. Something to always keep in mind. If anyone has any questions about the market center financials, how we got to be the most profitable market center in the Keller Williams ecosystem, we are happy to share those. You can actually access them yourselves on my KW and take a look at our balance sheet and income statement as models for your own business, what your expenses are, where your income is outside of commissions, and other things to track for your business. So I am not going to ramble on much longer and pass it over to Bobby. Let me give you screen sharing access too, Bobby.
Okay, cool. Congrats on being the most profitable in the world. I mean, it's hard to do anything and be the best in the world at anything. So that's pretty cool. But you know what comes with profitability? Taxes.
Great segue.
You gotta get out of those taxes, man. That's what happens. You make money, you gotta pay some taxes. But the goal is to not pay no taxes. The goal is to pay as little as legally possible in taxes. Because if you're paying no taxes, you're probably making no money. So you want to pay some, but you just want to pay as little as you have to. That's the game. All right. Do I have a screen share?
You should.
Okay. Yeah, I got it. All right.
Okay.
All right, so let's make this full screen. Okay. All right. Are we good? Everyone can see this? We're good? Okay. Yep. So I'm going to try to break this. I've been told I got 20 to 30 minutes, and I'm going to try to break it into 2 halves. We're going to look at assets, liabilities, net worth, basically understanding what those things are, how to track them. And then we're going to get into year-end tax strategy. So the year-end tax strategy, I want to leave as much as I can to that part because it is super relevant. Any tax strategy you want to implement prior to, like, for the 2022 tax year to save money in 2022, that stuff needs to be done in the next 2 weeks. So there are certain things you have until, you can do in 23, like contribute to a Roth. But I'm telling you, for like if you're trying to do business savings, we got to get, I'm going to stop rambling. We got to get there. All right. Who am I? I'm Bobby. This is me with short hair. I got to get a new headshot. I'm the founder, managing partner of Breadify. I'm an enrolled agent. And basically I just help people save money on taxes as efficiently and legally as possible. What is Breadify? We just try to do this stuff a little less boring than your traditional accountant or bookkeeper. We work, all this stuff. I really don't want this to be a sales pitch. Let's just get into the stuff, but we help people with it. I like to start off these meetings with this sentence, which is essentially the easiest way to make another 10 grand is to just not give it to the government in the form of taxes. So it's not about what you make, it's about what you keep. And that's the whole point here is let's just keep more of that in your pocket. All right, this is the meat and potatoes of the accounting equation and the wealth equation. So I present on this kind of stuff all the time. I just built this slide for this based off what Mike wanted me to talk about. And I haven't seen much of anything presented on it this way. So I hope you guys enjoy this and I hope this makes sense. And if this doesn't make sense, this is like super foundational. So please tell me to explain it in a different way because this is super important stuff. The foundation of all accounting is the accounting equation, right? And that is this top one. Assets equals liability and equity. In order to understand this equation, you have to understand what each of these three words mean. And I'm telling you, you can go to years of accounting school and memorize this equation. Very few people can explain this equation. And if you can explain this equation and actually understand it in your head, you will be ahead of 95% of people, and especially 95% of business owners. Okay, so we're going to get into what that means. But what I wanted to show right here is that the accounting equation and the wealth equation is essentially the exact same thing. It's the same equation with different words looking at different things. All right. So the accounting equation is assets equals liabilities and equity. And then the question is, why does assets equals liabilities plus equity? Assets are things that you own. It's as simple as that. You own certain things. It might be the money in your bank account. It might be your computer. It might be, I don't know, the supplies in your home office. Like you own things or your business owns things. Those are assets. And then there's only two different claims on those assets. They're either liabilities or equity. Okay. So let's just use round numbers real quick. If I have $100 sitting in my bank account, all right, that's it. I started a business. I put $100 in my bank account. I, as the owner of that business, put the $100 in my business bank account. How does this equation work? Well, I have $100 worth of assets, right? So this side, the left side of the equation is 100. Do I have any liabilities? Did I go to a bank and ask them to give me $100? Did I go to Mike and say, hey, Mike, can I have $100 to put in my business? No, I put that $100 into my business, which means equity. It's basically net equity or owners. It's what you as the owner of the business, that's your claim to your assets. This would be 100. So the way this equation would read, if I as the owner of the business put $100 in my checking account is 100 equals 0 plus 100. It holds true because what's happening is the left side of the equation is things that you own, real tangible things that your business owns. All right. The right side of the equation is who owns those assets. Do creditors own those assets or do I as the owner of the business own those assets or have a claim to those assets? So let's take that same example, but let's go with Mike. I start a business and I say, hey, Mike, I got a great business idea. Can I have $100 to start it? He's like, yeah, sure. I trust you, whatever. Here's $100. Now I'm still sitting with the left side of my equation. I got $100 sitting in my bank account. Who has the claim to that $100? Just because it's sitting in my bank account doesn't mean I own that $100. The way this would read, if Mike gave me that $100, is 100 equals 100 plus 0. All right. It's as simple as that. This is the accounting equation. You have assets. You have who owns those assets. That's it. Now, if we flip that into wealth building, the wealth equation of like, I want to know what my net worth is. So I kind of did a 1, a 2, and a 3. So if we take this equation and we flip it, a little algebra here. I don't want your, don't get crazy. It's super easy algebra here. You have assets minus liabilities equals net equity. That's essentially what it is. Net equity. It's what's left over. You have things you own. You have creditors. What do they own? And then whatever's left over is what you own. That is net equity in a business. And if we take that same example or that same equation, but move it to you as an individual. So we're no longer talking about your business, whatever, ABC, LLC. We're talking about you as an individual. Take the same thing. There's things that you own, like a personal residence, maybe your car, money sitting in your bank account, whatever, minus liabilities. Maybe you took some debt out for the car. Maybe you took some debt out for your home or your investment, whatever you have. Whatever's left over is your net worth. It's as simple as that. The assets and the accounting equation and the wealth equation it's all the exact same thing. One is looking at assets owned by an entity, such as a business, and the other one is looking at assets owned by you as an individual. So if you just think of your own life as a business, that is how you find your net worth. It's essentially a balance sheet of your life. You have, what do you own? What do you owe on what you own? What is left over? That net worth, that leftover amount is your net worth. So that's essentially it. Does that make sense?
Let me,
yeah.
Sorry, let me put this in terms that hopefully everybody's going to understand. For your clients, right? They buy a $200,000 house. They put 20% down. They immediately have 40% equity.
Mm-hmm.
They have a liability for $160,000 on a $200,000 asset. As they pay every single month, they're building equity.
Yep, absolutely. Absolutely. Yeah. So that is the way it would work. Regardless of whether that's your primary residence or a rental property, right? Yep. You are building equity, which is this equation. So that falls in, you have an asset, right? So the asset is, what did you say? 200? Is that what you said?
$200,000 house.
All right. All right. So we're saying 200,000, right? So the way this equation would read with that example is you have a $200,000 sitting on the left side of the equation, $200,000 worth of asset, which is that home. The liability is, would you say 160? So you have the 160 of liability. You don't own that full $200,000, right? You own what's left over. So the way this would read is $200,000 minus 160. That's that note or the mortgage to your lender. What's left over is what you own, net equity. It is the net. So you have the asset. What do you owe on it? That's what you have left. Does that make sense? I mean, that is probably the easiest way to understand as like a real estate.
Well, and I bring that up because we need to teach that's a great thing to teach your clients, right? And the easiest way to go do another transaction is to teach everybody you did a transaction with last year about investing.
Absolutely.
Because I know you're going to get into it a little bit more, but around net worth, like real estate is a great way to grow your net worth.
I'm just going to say this right off the bat. I've looked at a lot of tax returns. All right. And I'll tell you one thing that successful people have on their tax returns. They own real estate, and specifically income producing real estate, whether it's commercial, residential, whatever, I don't care. They own rental properties that give off cash flow. It appreciates in value. You get the tax savings of depreciation. Like you guys as real estate professionals hit the holy grail of tax saving strategy because you qualify as a real estate professional. I know I've talked about this in the past, and I don't want to go on a tangent about this because I got to hit these year-end tax strategies. But if you know what you're doing as a real estate professional, or if you have a good team behind you and you take necessary precautions, which is essentially become a real estate professional, which means you work in a real estate trader business for at least 750 hours a year, which a real estate agent or broker that qualifies, right? So you're doing this full time, and then you go and invest in rental property. That combo right there is the holy grail of tax savings because you get to do what no one else can do. You guys have the greatest lobbyists in the world. All right. It's the reason Donald Trump pays no money in taxes because of real estate professional status. You guys have rental properties that might be cash flowing in real life, right? You might be getting a check in your pocket every month, but because of the phantom expense of depreciation, you show a loss on that property for tax purposes. What happens for everyone else is that loss gets trapped over on the right side of their equation. It's basically a passive activity loss, and they cannot use that loss to offset their ordinary income. But real estate professionals with the greatest lobbyists in the world, they say, whoa, 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 I'm a real estate professional. Why can't I use those losses? Okay, fine, you can do it. So essentially now you have these losses and you can offset it against your 1099 income or your W-2 income or any other ordinary income you're generating, which no one else can do. So there's that. Does that make sense? I mean, because you guys as real estate professionals, like this is so important for you guys specifically because of how great your tax saving strategy can be with just a little bit of preparation and setup. All right. Okay, this is I'm gonna hit this super. How much time do I got? What do I got? I got I think we're still good. All right. With what we just hit were these first three accounts: assets, liabilities, equity. These all occur on the balance sheet. You know, you have the two main financial statements that everyone knows: the profit and loss and the balance sheet. You got your income statement, which is the same thing as the profit and loss, and your balance sheet. It's imperative that you as business owners or just being financially literate understand what are on these statements and how do you read them. What is the story that each one of these statements is telling you? Because that is the foundation of understanding a business. And of every transaction that occurs in a business, it must fall into one of these five accounts: assets, liabilities, equity, or income and expenses. There's five accounts. They're mutually exclusive, which means you can't have one transaction be, you know, it's kind of an asset, kind of an equity, kind of it's one or the other. Everything's going to fall into one of these five accounts. And so what to understand from this is, of the five, assets, liability, and equity, those are on the balance sheet. Income and expenses, that's on the income statement. The story of business and the story of your life and wealth building, it's all about assets. Nothing else is real. Everything else is it's essentially, you know, like we were talking about claims to assets, or it's doing things. It's all about assets. If you want to build wealth, if you want to grow your net worth, you buy assets. You buy assets, like with that rental property, you may purchase the rental property, you may have debt on the rental property, but you're going to pay off that debt. And every time you're paying that off, you're going to pay some interest and you're going to pay some principal. When you're paying that principal, you're building equity, which means you're growing your net worth. So it's, how do I accumulate as many assets as possible? So this goes for growing your business and this goes for growing your personal net worth. It's the same thing. All right, like this is all the stuff we just talked on, and I really want to hit these year-end tax strategies because there's so much there. So assets, real things, tangible or intangible, real things that a business owns or you own personally that has value, produces income. Liabilities are just claims to assets. It's not money. It's never tangible. These are things like debt, obligations, claims. Oh, like this is the definition: a legal claim by a lender to the assets of a business or of an individual. So liabilities are not things. Liabilities are claims to things. Equity, same thing. It's not money. It's not tangible. This is things like capital, stock, retained earnings, etc. That's what it's called in a business, but it's just an owner's claim to an asset. It's not the asset itself. It's a claim to an asset. I really hope that makes sense, because if you understand that assets equals liabilities plus equity equation, you understand accounting better than a lot of accountants. It's that simply, that you just really have to understand that foundational equation. These are the final two: income and expenses. The easiest way I can explain this is it's what you do. Like you remember those commercials, Verb, it's what you do. You have income, you have expenses, right? If I ask people, what is the sound of money? A lot of people would say like cha-ching or whatever, you know, like it's the receiving of the money. That's not what income is. Income is you doing something, providing value, providing your good or service to a customer, and that is the sound of income. So if you mow lawns for a living, the sound of income would be the sound of a lawnmower. You actually using a lawnmower to produce income. Verb, it's what you do. Expenses are the opposite of that. It's basically value sacrificing activities. It's the expenses you need to incur or consume or use up to produce that income. And the income minus expenses gives you your income statement. All right. The easiest way to understand, like to think of the difference between the income statement and the balance sheet, is an income statement is a movie of your business. So it's a recording of how well your business has done over a certain period of time. So if you're looking at an income statement, there's always two dates. You have the date that it began, maybe it's January 1st, 2022, and the date that it ended. Maybe it's 12/31/2022. How well did your business do over that period of time? Is how much money did you make? What'd you spend the money on? Then you have a net income right at the bottom, and that is your income statement. The balance sheet is a snapshot of your business at any point in time. So When you look at a balance sheet, there's only one date. It'd be like balance sheet as of 12/31/22. It's not a balance sheet through 1/1/22, 12/31/22. It's what does my business look like as of this date? And what it's going to show you is what does my business own? What does my business owe? And what is left over for the owners of this business? That is that same equation: assets, liabilities, equity. All right. I hope that makes sense. Here are some softwares that we were talking about here. Growing your business and having a profitable business is the same thing as growing your personal life and having a positive net worth. So I highly recommend using software to do any of these things just because of how much easier it is. I know Mike is a master of Excel and he likes using Excel, and I've seen some real high quality stuff coming out of there, but it's not for everyone. I recommend using some sort of software. The one I've used personally, Mint, it's owned by Intuit. They purchased it a while back. It's free. They do a really good job. I believe YNAB and Personal Capital are both paid for, but they do similar things. They're tracking your assets, your liabilities, and showing you your net worth. All of this stuff is for your personal life. You would not use Mint to keep track of your business income or your business expenses. You're not using Mint to see what's the balance sheet on my business. You are using Mint to keep track of your personal life, and that's very important. One of my biggest pet peeves is commingling of funds between personal and business life. You've got to separate those out: separate checking, separate cards, all that. So for personal, if you want to track your net worth, Mint, YNAB, Personal Capital, all very good softwares. For business, QuickBooks Desktop, QuickBooks Online, Xero. Those are probably the three biggest. I don't have enough time going into all of those things, but this is kind of the breakdown. If you want to track net worth, use a software, but make sure it's a different software than tracking the income and expenses and balance sheet of your business. All right, we're going to hit year-end tax strategies. Any questions on that? Okay. I feel like I'm just kind of rambling. I'm trying to do as much of this as I can, and I'm hoping that this is making sense.
You're nailing it. This is going to be the trailer to what's going to be a series of business-based stuff that you're going to be doing.
All right, that's fine. Listen, I can talk about this stuff for literally. See this list right here? Just the list. Say, let's just take paying your kids. I could talk for an hour on the strategies on paying your kids. So each one of these things is like a strategy in and of itself. And I'm just trying to hit the points so that you have these in your head. Some of these might not apply to you. Some of them will. Just have them. Oh, that one sounds like that one kind of applies to me. Go ask your tax guy. Go ask your CPA. Go ask your whoever. Or some of these you could just do yourself, right? These are just things to get you thinking on what should I do or what should I be considering prior to the end of 2022. So I'm going to hit these, and then I got a little bit of information on each one. And I'm trying to get as many of these as I can. And Mike, I don't know if people are in the chat or anything like that. If there's something on here specific that people want to learn more about, I can go more in depth on one or two of these. So just let me know. Let's just start at the top. Retroactive S-election, payroll, contributing to a solo 401k or establishing a solo K, SEP IRA, Roth IRA, your HSA, accelerating large expenses into 2022, pushing income or commissions into 2023. New entity setups, old entity dissolutions, year-end accountable plan reimbursements, nominee income agreements for 1099s, board of advisor agreement, paying kids, and tax loss harvesting. We're just going to start going through these, but this is just a list of all of the things I'm helping my clients and members go through and think about and figure out what do we need to do prior to the end of the year to implement these things and save money on taxes for 22. All right. This is probably the most important for people who had a really good 2022. If you had a great year, you made a lot of commissions, all 1099, and you're like, I'm going to get screwed on taxes this year. You want to look at, are you eligible to retroactively elect to be taxed as an S Corp? And the determining factor is, did you have an entity set up? I'm talking an LLC, most likely, set up as of the beginning of this year. If you had an LLC, even if it was just a normal LLC, sole proprietorship, you're the only owner, you never made an S election. If the entity was in existence as of 1/1/22, you could retroactively elect to have that S corp taxed the LLC taxed as an S corp going all the way back to 1/1/22. But let's just say you were operating as a sole prop throughout the year. You get to October and you're like, wow, I had a great year. What should I do? How do I save money on taxes? If you then go and set up an LLC that day, October 1st, and you said, I want to save money on taxes. Well, I can have all the money you make from 10/1 to the end of the year taxed as an S Corp, but everything that you made prior to that entity start date cannot be taxed as an S Corp. You're going to have to bite the bullet on it one more time. And then going forward, you'll be taxed as an S Corp going forward into 23 and all of that. So the determining factor on can I do a retroactive S election is, did you have an LLC set up towards the beginning of the year? It doesn't need to be 1/1/22. Maybe I opened my business up 2/1/22. You can still do it, but you can only retroactively elect 2/1/2022 forward. So let's just say you made a commission check in 2020 or in January 5th of 2022. That is not going to go through your S Corp. It can't. It didn't exist. So you would still report that on your Schedule C. Same way, still pay self-employment tax on it, but everything from 2/1 forward would be S Corporation. It's pretty simple to do this. Any tax professional should be able to help you with this. You file a retroactive S election, which is a form 2553 with the IRS. And you have to make sure you're citing a specific rev proc right at the top and give a reason for why this is late. You can do this. It's really not hard. Or you can pay a tax professional probably a couple $100 to do this for you. All right, I'm going to keep moving. Was there any questions on this specifically? Keep going. All right. Payroll. This is very important. If you do go the S Corp route, let's just say, yes, I'm an S Corp, or yes, I'm going to elect to become an S Corp for the 2022 tax year. Now this becomes imperative because as an S Corporation, you need to run payroll for yourself. You need to take what's called a reasonable salary according to the IRS. So you need to do this before the end of the year. This is literally what I've been doing all day, every day for the past month. It's helping our clients get payroll tax IDs and setting up S Corps and making sure that retroactive, all of this stuff needs to happen in the next 2 weeks or you're done. And you're going to have to wait another year to become an S Corp. So payroll becomes imperative if you are already an S Corp or if you plan on doing the retroactive S election for 2022. Tax preferred accounts. These are essentially your options. There are others, but these are the most common tax preferred or retirement accounts. These are fantastic for building wealth. And by far the best one is a solo 401k for real estate agents. Real estate agents should have a solo 401k for their business. This is, a lot of people are familiar with the SEP. There's a saying that goes, I screwed up and did a SEP. SEPs are a worse version of a solo K. Solo K, the only time you wouldn't do a solo K is if you're not eligible. And by not eligible, that means you have other W-2 employees. So if you have an assistant who you pay via a W-2, because they're with you all day, they're 9 to 5, and you're telling them what to do all day, you cannot do a solo K. You can still do a safe harbor traditional 401k, but you cannot do a solo K, hence the name solo. If you can do a solo K and you are trying to build wealth, you should absolutely be establishing and setting up and contributing to a solo 401k for your business. The only downside is you can't do it if you have W-2s, all right? The SEP IRA screws you up a lot of different ways, but essentially you have to take a much higher self-employed, like W-2 self-employment set. You're going to be paying much more in taxes to get the same amount into a SEP IRA than you would getting into a solo K, which is why it's worse. The other thing that it screws you up with is if you are a high income earner and you want to do a Roth IRA, we highly recommend Roth IRAs. I never go traditional. Probably 95% of my clients, Roth IRA, way to go. Okay. The problem with Roths is there is a limit. You can't go directly contribute to a Roth if you make over a certain amount each year. It's not even, it's like I have 150, it's just called around 150 grand. All right. If you are considered a high income earner, you have to do what's called a backdoor Roth IRA, which means you got to make a non-deductible traditional contribution, roll it into a Roth IRA. It's super easy to do. It's just an extra step. What happens is if you contribute to a SEP IRA in your business, you can't do the backdoor Roth IRA because the IRS they combine all your IRAs. So the SEP IRA is included. What they don't include is the 401k. So I know that might not make sense. That might have been too high. I don't know. But the bottom line is SEP IRAs not as good as solo Ks. If you are eligible for a solo K and you want to build wealth, use a solo K, not a SEP IRA. Lastly, we'll touch on the HSA real quick. HSAs are awesome tax saving tools. You need to have a high deductible health plan, a qualifying HSA plan to contribute or open one and contribute to it. But if you do have that type of health plan, you should absolutely be maxing out your HSA every year. It is the only vehicle in the United States that is triple tax benefited. That means you get a tax deduction on the way in, you can invest that money tax-free, and it all grows tax-free. And then you can pull it out tax-free at any age, no tax. You literally got a tax deduction, grows tax-free, pull it out tax-free. You paid no tax on this money as long as you're using it for qualifying health care expenses. Publication 502 with the IRS tells you all the things you can and cannot spend this money on. But you can literally invest this money. It's not just stocks and bonds. You can buy real estate with your HSA. One of the tax attorneys I work with, he owns a rental property, little meth lab, he likes to call it, in his HSA, produces income. Boom, income, paying for his health insurance. Someone else is paying for it. Yeah, it's amazing what you can do. Personally, I like Bitcoin. That's people are gonna be like, oh, well, Bitcoin, it's been going down. Yeah, that's why I buy more. I buy more Bitcoin now. I just want that on the record. All right, cash basis taxpayers. This is kind of the accelerate. You as a cash basis taxpayer means whatever you do in this tax year, it's going to apply. It's based off of, did the money leave your account or not? Or did you constructively receive the income or not? So if you're looking at the end of this year, and this is more imperative than any other year in the past, because we have 100% bonus depreciation rate now. Basically what that means is if I go out and buy a $10,000 piece of equipment and I want to write off the whole $10,000 this year, I can do it. I can do it because of 100% bonus depreciation. But starting 1/1/23, the phase out begins from the Tax Cuts and Jobs Act. That means you are going to, next year it's 80%, then 60, then 40, then 20, then 0. Okay. So if you want to, if you made a bunch of money this year, and this is even more important if you're like, I can't do an S Corp, what you can do is try it. You can go out, buy a new vehicle, only if you need one. I'm not telling you to go buy a new vehicle if you don't need one. But if you go and buy a new vehicle and it's over 6,000 pounds, I don't have time to get into all the specifics of this, but the bottom line is, if you want to go buy expensive equipment because you need it in your business, you can bonus depreciate it this year in 2022, get the full tax deduction in 2022. All right. The other flip side of that is if you have a commission check that may be clearing, or if you're going to get paid by a vendor or whatever it is, if you don't constructively receive it, which basically means they don't pay it to you until 2023, then you don't pick it up as income until 2023. That does not mean someone hands you a check and you just decide not to deposit it until 2023. That's not how it works. If you constructively receive the check, you earned the income that year. So I'm saying the money, literally, you cannot have control of that money in 2022. And if you get it in 23, then you can pick it up in 23. All right. The end of the year is a great time for either setting up a new LLC or shutting down old ones. This is very common for my clients who like to move around to different states all the time. They're like, oh, I'm no longer in New York, I'm in California. I'm no longer in California, I'm in Arizona, I'm in Texas, I'm blah, 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 whatever. If you're doing that, a lot of the times it's easier to shut an entity down as of the end of the year, start a new one up in the proper state going forward. So that's just something to keep in mind. If the end of the year is a great time to shut old down entities you're not using or starting new entities that you plan on using into 2023. All right, this is for S Corps. The accountable plan is imperative if you are an S corporation. It's basically a reimbursement program for you as a business owner to pay back expenses as an employee. When you are an S corporation, you are both the owner of that business and an employee of that business. All right, so that means you have to think of yourself as two different people. If you're trying to write off your home office in an S corporation, you need to do an accountable plan. If you want to write off your car and truck, and that truck is not a 100% owned business vehicle by the business, you need an accountable plan. So this document, it's basically a document you sign with yourself, and it's an expense report you do quarterly. This is super important to do once you are an S corporation. I don't have enough time to go into how all of this works, but you need to do this if you want to get the home office deduction, auto, internet, cell phone, travel, meals, these types of expenses as an S corporation. This is probably one of the biggest drawbacks of having an S corp is this extra hoop you have to jump through to keep the IRS happy. Nominee income agreements. This is very common for real estate agents. If you are receiving your 1099 to you personally, right? So it's in your SSN. That means you need to report that on your Schedule C, even if you have an S corp. Otherwise, the blaring alarms at the IRS system are going to go off being like, this person didn't report their income. So what you can do to have an S corp, even if the 1099 is in the name of you personally, is do what's called a nominee income agreement. It's essentially a way of saying, yes, IRS, I did receive, say, $100,000 in my own name, but I only received it in my own name for the benefit of this corporation. That's where you can find the actual income. So you're using a nominee income agreement to say, keep the IRS happy, to make sure the IRS alerts don't go off saying you didn't report your income, and you're showing them where you are reporting your income. So if your 1099 is going to your personal SSN, you need to do this. I would recommend changing it to your EIN as soon as possible, because it's just a much cleaner process. Hopefully that makes sense. This is a great tax strategy, setting up your board of advisors, right? If you're like, whoever you talk business with, if you're like, hey, I'm going to my family's house for Christmas and you want to find a way to write that off, ask your mom or dad to be a member on your board. Go have a board meeting. You want to write off your Thanksgiving dinner, your turkey dinner, have a board meeting before that. I'm telling you, like, these strategies, like, you can use these fully legit strategies as both tax savings as well as on asset protection. I mean, having a board of advisors meeting quarterly is a fantastic way to grow your business, but also improve the asset protection of your business by strengthening that corporate veil. All right, paying your kids. Like I said, this is a whole thing in and of itself. If your kids are under 18 versus over 18, there's a different way of paying your kids. And if your tax is an S corp versus an LLC, there's a different way of paying your kids. So it's like a quadrant going on here. So you have to find where you fall. Typically, where our clients fall would be S corporation, under 18 kids. That's what ends up happening a lot of the time until their kids are older and then they're over 18. But paying your kids in your business is a fantastic strategy. One of my favorite. It gets your kid, get your kids working in your business, teach them the value of a dollar. You're opening up the door to contribute to a Roth IRA. You're teaching them a day's hard work. You get to spend time with your kids. There's a lot of benefits of having your kids work in your business, both for you and the kids. So high level, the way this would work is you pay your kids out of the business for jobs that they have done reasonably in your business. All right. They now have earned income. They don't pick it up as income as long as they're under the standard deduction federally and state. And then they can take that earned income, put it into a Roth IRA. Now your kid has a Roth IRA and you can invest it for them. You can invest it with them. You could teach them about investing. It all grows tax-free. And then they can also pull out the $6,000 or the $6,500, whatever it is, every year. No, like that, the money they put in, pull it out, no penalties, no interest, because that's after-tax dollars you put in. You just cannot pull out the growth of the account until they're in retirement. So awesome strategy here. Paying your kids, highly recommend doing it. Lastly, tax loss harvesting. This is not really a business owner strategy. This is more just like if you have investments, right? And you want to sell those investments, realize the loss to help offset other capital gains, you can do so. You can also use up to $3,000 of your cap losses to offset ordinary income. And you just got to be aware of this 30-day wash sale rule. Basically, you can't, if you sell an asset, realize that loss, but then immediately go back and buy that asset again, it gets offset. But the IRS is saying, I see what you're doing here. No, you're not allowed to do that. No, you cannot take that loss. So if you're going to do that, and you're like, I'm going to sell an asset because it's at a loss, but I still want to keep that asset long-term, wait at least 30 days and then buy it back. All right. That's, I believe it. All right. Is there any other question? I can't believe I made through that. Was there any questions on any of this? Is anyone there?
I don't see anything in the chat,
Right.
but we have this recorded and I know you're going to send us a slide. So thank you. A ton of information, and Mike just stepped out, but he's right. We are already kind of like plotting and planning a way to create a series on these topics with you for our agents. So thank you so much for all the information.
Yeah, absolutely. Yeah. And I'm happy to do that. I'm happy to teach and explain this stuff as much as possible, because I just think it's so important and no one teaches it in school or in the real world, really. And I also special offer for just KW agents is I personally will do a 30-minute tax consult, like complimentary, no fee, for only KW agents. So if you are interested in that, I'm happy to do that for you. We're a little bit booked up right now just because it's the end of the year and we're super busy, but this 30-minute consult, breadify.com/KW tax consult, if you want to set one up, happy to do that for you, fully complimentary.
Yeah, Bobby works with a handful of our agents and teams now in the office. So a great resource for you guys if you have any questions or are looking for a better accountant to save you more money. All right, Bobby, thank you. Thank you
All
everyone
right.
for joining. Have a good day.
Thank you, you too. See you guys.